Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's lecture, guys, is on retracement levels and why they matter. I see a lot of folks out there taking trades that are crazy, silly, stupid extended. They're up 5, 6, 7 bars and they want to buy the high of the day. I see people taking stocks that have retraced 120, 130% from their highs and they want to buy it. Go, well, the stock has to bounce. No, it doesn't have to bounce. One of the things I'm also noticing is because of the pandemic since March, the markets have been absolutely unequivocally bonkers, crazy, nutso. Honestly, I've been doing this 15, 20 years, and I have never seen a market as crazy as this. Even the tech boom in the late 90s wasn't like this, in my opinion. We're up 60 or 70% from the bottom in March in a 4 or 5 month period. So the point I'm making is a lot of people are getting used to this irrational exuberance. They think it's normal. I'm here to tell you, it is not normal. This too shall pass, so they say, right? So we will get back to a semblance of normalcy. The reason I'm commenting on this, yes, there's a lot of opportunity to make a lot of money right now, but some of the ways that you guys are trading are not going to work in the future with regard to taking stocks that are super extended. I've seen people take Tesla when it's up 5, 6 days in a row. They just hop in it on a whim and it goes even higher and they think they're a genius. You're not. It's going to bite you. Don't spend that money because the market wants it back. So today we're going to talk about retracement levels and why they're important. What's the difference between a 30% retracement, a 50% retracement, a 100% retracement? We'll talk a little bit about Fibonacci level retracements as well and why price really is the only thing you should be focusing on. But retracement levels, guys, this is one of the most important lectures I've done outside of money management, because that's always number one, protecting your backside, protecting your account. Risk control is number one. But outside of that, understanding when and where a stock is likely to pivot to go higher or go lower is one of the single most important things you can learn in trading. All right, so stick around for that, guys. As always, if you like this video, please click that like button. And again, subscribe. It's a great channel. There's lots of hardcore, awesome information. So please subscribe to the channel. Today's topic, guys, retracement levels and why they matter. I'm Jared Wesley. Let's get to it. This week's topic, guys, is retracement levels and why they matter. It's a very, very, very important topic, and it's worthy of all three verys that I just talked about. Number one in trading is always money management. If you can protect your ankles, protect your downside, risk control, you'll never be in big trouble. But you could argue the second most important thing in trading is understanding a chart and when and where that chart is going to pivot or where it's likely going to pivot. Okay, so that is retracement levels, and it's a topic we haven't talked about extensively. There's a little bit of it in professional trading strategies, obviously, because there's everything in professional trading strategies, but pivots and retracement levels are extremely important. Understanding the concepts behind why something pivots, or the likelihood of it pivoting and why it should pivot, okay? And that's the part I want to dig into today, kind of the psychology behind it. But before we do that, we have to do a little bit of when will the insanity stop, okay? We can't go through a week without having a great when will the insanity stop session. So I have two for you guys this week. One of the things I continue to say to you guys is it's not always about the sheer dollars. It's about the idea or the principle of something, okay? Because to some people, you know, $1 or $100 is a lot of money. To other people, $100,000 isn't a lot of money. It's about the idea of what these people are doing. So this week, common sense is really a superpower is the theme for this week's When Will the Insanity Stop? Okay, so it finally happened. I blew up my account today after getting cocky and ignoring my rules. I had been doing pretty well, trading momentum. Okay, this is the best part though, but today I got into JRJC and I kept averaging down, thinking it found support, but it never did. I want you to reread that. I kept averaging down. It's never a good idea to average down. Sure, you'll get away with it from time to time. You absolutely will get away with it from time to time. But the 1 or 2 times out of 10 you don't get away with it, it's an account destroying experience, okay? Or at least severely damaging your account type experience, okay? So
Somehow I'm calm about it. 30 minutes after closing out my position, I blew up my account today, and yet I feel like it made me a better trader. Honoring my stop loss rules going forward will be easy, knowing just how bad not honoring them can be. Guys, that's the truest thing this person said. At least there's recognition here that somebody realizes, wow, stop losses are actually important compared to what you're being taught on Google. Mental stop losses, don't worry about it. I told you guys a few weeks ago, I saw somebody out there literally lose, or I shouldn't say lose, was down $5,000 or $6,000 just to get back to plus 1,000. Where was the bottom? Who knows? Who knows what the bottom was? I know the trader, when they showed it, was pretty, let's just say, on their edge of their seat. So clearly it meant something to them. So guys, take your stop losses. Just don't be an idiot, all right? I know you all think you have common sense, but if everybody had common sense, well, we wouldn't be having these discussions, would we? We really wouldn't be. That's just the truth of the matter. So here's another one. Hello, Jared. I'm very frustrated right now. I bet you are. Okay, it's like Dear Abby. Okay, I began trading options recently, and that word recently is very important. I began trading options recently. Okay, was having some success. I actually made money every day for 2 weeks straight. I was able to grow 1,000 to 10,000. Think about that for a second. I was able to grow $1,000 into 10 grand. You're gambling. If you could take and make 1,000%. And you just started trading, quote, recently, you're a gambler. Plain and simple. However, remember I always tell you guys, don't spend that money because the market wants it back. Well, here you go. Last Friday, I lost $4,000, and this week I lost another $4,000, so I'm back down to $2,000, okay? I'm going to skip a whole bunch of crap in the middle. The following Monday, I wanted to make the money back. I lost on Friday, so I bought $4,000 worth of Barrick Gold calls because Warren Buffett was announcing his investment in the company. I'm sorry, does it get any dumber than that? I apologize for using such harsh language, but why in the world would you just buy a stock because Warren Buffett did it? I mean, there was somebody today that was looking at a stock and like, what the CEO just, literally, this just happened in the chat room today, but the CEO bought shares of it. So what does the CEO buying shares have to do with your trade? What does Warren Buffett announcing his investment in a company have to do with your trade? It doesn't. And then this is the best part. I believe these stocks are being highly manipulated. Not sure where I went wrong. And this is even the bestest of part. This is like the cherry on top. Wait, my logic seemed sound, I think. Huh? Your logic seemed sound? You're on like Planet Delusia. Okay, that's where you are. If you put your brain in a parakeet, it would probably fly backwards. Okay, what do you mean your logic seems sound? You got into a stock because Warren Buffett announced an investment in it and you thought that was sound. No, it's not sound logic. That's exactly what stupidity looks like. I'm not being mean. I'm trying to help people out there. I'm trying to be as hardcore as I can so you will never, ever, ever be in this position, ever. Common sense really is a superpower. Okay, all right. Let's talk about retracement levels, okay? I think we did enough of the insanity today. Retracement levels, okay? Very important topic today. Retracement levels are used to measure the strength or weakness of a move, okay? They're used to measure the strength or weakness. They help us determine if the current trend will continue or if it will likely reverse. The level of retracement helps us determine this. It also helps us determine the odds of success. That's very important. The level of retracement helps us determine this, okay? It's extremely important, guys. I use terms like level and depth of retracement. Level and depth of retracement. I'll also use terms such as angle of retracement, right? If a stock pulls back on one bar, say 100%, that's different than a stock taking 5 or 6 bars to pull back 100%. So those types of terms, level of retracement, depth of retracement, angle of retracement, are very, very important, okay? So understanding those things, which we'll talk about today, is going to help us determine whether or not this pullback or this pivot has a higher or lower odds of success. Okay. In short, guys, retracement levels help keep our expectations in check. They keep us objective. And that's something many traders are not. You're not objective. Just admit it. You're not that objective. So given the prior pivot compared to the current pullback, we can surmise what might likely happen next. What is technical analysis? Technical analysis is using past price action to help us predict future price movement. The key here, though, and we're going to talk about it, is understanding the psychology behind it. Just because something's an 80% retracement, so what? That doesn't mean a whole lot in and of itself. Understanding why an 80% retracement is not very bullish, that's a different topic, and we're going to get to it, okay? So, as you guys know, I am not a big fan of indicators. So one of the things we'll look at briefly today are Fibonacci retracements, 38.2, 50%, 61.8. Try to predict support and resistance points. That's what Fibonacci does. I bring this up because, well, they are levels of retracement, and a lot of people use Fibonacci retracements, Fib retracements, right? So therefore, they can be at times, self-fulfilling prophecies, okay? So it's important, though, to note that Fibonacci reversals or reversals at Fibonacci retracement levels typically occur when other concepts confirm. This is extremely important because you guys know how I feel about multiple concepts converging in an area. So when you see a trend line or a moving average or a prior pivot or a bottoming tail or increased volume, that is when reversals become far more reliable. So just because you see, oh, it's retracing 61%, it's right at a Fibonacci level, okay? Just because it's in that area doesn't mean it's going to bounce. You have to confirm it with trend lines, moving averages, prior pivots, etc. So we all know, because we talked about it last week, that price and volume are the number one thing you're going to look at. They come first. So after confirming a pivot based on price, then you can look at Fibonacci's moving averages to help validate or confirm what you're seeing. I'm going to repeat that because it bears repeating. Once you see price and then some volume, then look at bottoming tails and topping tails and doji bars and the retracement levels and Fibonacci's to help validate what you're seeing. Price always comes first. So here's an example, guys, of Fibonacci retracements, okay? I do not, to be clear, I do not put these on the chart. But if you take the top of the pivot, which is 108.69, okay, and you take the bottom area of this here, I guess you could use a slightly lower area, but they're using this bottoming tail of 103.75. So the top to the bottom, this is how you're getting your Fibonacci retracements. So this right here, 105.63, that's a 61.8% retracement. 106.8, that's a 38.2% retracement. So Fibonacci is basically saying the stock should bounce in this range. So basically you call it 40 to 60%, right? The stock could bounce between 40 and 60%, all right? So it's not saying it definitely will, but this is where I'm going, guys. You can use Fibonacci retracements to help you if you want. But make sure there are other things confirming the Fibonacci retracement. So for example, in this case, you have red bar, green bar, red bar, and this is a wide range red bar. But what is following the red bar? What's coming after the red bar is a green bar. And notice where it's happening. It's at this prior area of price support, right? Minor price support. So this isn't just a 50% Fibonacci retracement. It's a 50% Fibonacci retracement with a green bar at price support. We don't have volume on this chart. So you see the stock bounce up. So don't think that the stock is just randomly bouncing at 50% because you have a Fibonacci on your chart. It's bouncing in that area because it's at price support, because there is a green bar, and because it's on that 50% level, okay? So when you talk about retracements, don't just look at one thing. Look at the big picture, and trust me, we're going to go much deeper into this in a couple minutes. So I don't use Fibonacci's, but I thought I would bring them up just so you guys can see, hey, some people need to know where that 50% level is or where that 40% or 60% level is, okay? So the point is, if you want to see it more clearly, you can use Fibonacci retracements, but make sure you're getting confirmation from other things. We'll talk about it. I want to go deeper now, guys, in terms of the psychology of this. So what we have here, guys, is a hypothetical $20 stock, right? At the top of the pivot's $20, at the bottom of the pivot's $18, and right in the middle is 19. 19 obviously would be considered a 50% pullback. So the question now becomes is, what's the meaning here? When a stock pulls back 25% or 50% or 100%, what does that really mean? Well, clearly, if we start on the left-hand side, This stock pulled back from 19 to 18, and then it ripped. It went from $18 all the way up to 20 bucks. Okay, that's a pretty big rip. Okay, so the question then becomes is how do we know, right, what the appropriate level of pullback is before it's acceptable to buy this stock long? That's the question, right? Isn't that the $64,000 question that we are all trying to figure out? How do we know what the appropriate level of pullback is to get into a trade so it will bounce and go higher? Well, here's the thought process behind it, okay? Stock is very strong. Good news, right? Because that means that we're in an uptrend likely and we want to buy the next pullback, okay? Assuming it's not climactic, that's key, assuming it's not climactic. So if the stock pulls back 25% right here, right where my cursor is, if it pulls back 25%, okay, what does that mean? Well, it means the stock is strong, but likely has not rested long enough. I want you to imagine you just ran a marathon. In this case, the marathon is from $18 all the way up to $20, okay? And then it pulls back to, say, $19.50. That's a 25% pullback. Well, some people might go, well, gosh, it's so bullish, buyers stepped up early. That is one way to look at it. But the more appropriate and proper way to look at this is this stock has pulled back and it has not rested long enough. Therefore, the move back up will likely be a shallow retracement because there wasn't enough time to rest, right? There wasn't enough time for this stock to catch its breath, that the bounce back up will likely be a shallower bounce because there wasn't enough time to rest. And it will fail sooner rather than later, making it a very tough or more aggressive trade to take, right? It's a much more aggressive trade. Now, if the stock pulls back 100%, right? You go from 18 to 20. The stock is clearly very, very, very strong. Pulls back from 20 down to $100, okay? Or 20 down to 100. 20 down to $18. That's 100% retracement, right? Well, now what's the problem, okay? What's the problem with that retracement? Well, why did it take so long for buyers to step up, right? If this stock is truly as strong as we thought it was, because it went from 18 to 20, right? Why did it take so long? Why are buyers looking for a discount before they're willing to get back in this? Obviously and clearly, it's not as strong as we thought it was. That's the only way that you can take it. There's no other way you can take it. If a stock moves from 18 to 20 and rips higher and then pulls 100% back to 18, where the move started, where the initial move started, you have to question the strength of the stock. If it were strong, buyers would have stepped up a long time ago. So now what does that tell us? It's not as strong as we thought, and therefore, because it's not as strong as we thought, the bounce is likely not going to be as good as we thought either. So note where it says target right here. The reason it says target is because we're only expecting a 50% retracement. Because of the pullback, the depth of the pullback, the level of the pullback, 100%, your expectation has to be lowered. You can't have the same expectation as you did up in here because we have new information, and the new information suggests the stock isn't as strong as we thought, and therefore with the new expectation, we have to readjust our expectation. Make sense? It makes sense. Logical, right? Now, what do we have in the middle? 50%. That's the ideal retracement for most pullbacks. The stock goes from 18 up to 20. It's very, very strong. We don't want too shallow of a retracement because the stock hasn't rested long enough, which means the bounce will probably fail. If the stock goes too deep, we have to question the strength and lower our expectation. But if the stock pulls right back to the middle, it's the ideal retracement level, which means the stock needed a rest because it was tired. It just ran a marathon. But it's still strong because buyers are stepping up sooner rather than later. Okay, so we have the perfect balance. It's gotten plenty of rest, and it's showing enough strength that it should bounce. Now, target up here would be first target, because when you get a 50% retracement, the expectation, which is always important to discuss when you take a trade, is that it will break the prior pivot high. The expectation is that we will break through the prior pivot high because of the 50% retracement. It's very important to understand the psychology behind the level and depth of a retracement. Now, remember though, we don't ever trade in vacuums. So you can have a 50% retracement that's really not that good. Maybe the way it pulled back, maybe it pulled back with one wide range red bar on big volume in a market that's pulling back. So there would be reasons not to take a 50% retracement. So what is our goal? Our goal ultimately is simple. Find reasons not to take a trade. And when we can't find a reason to take a trade, then we take it. And usually that means multiple concepts converging in an area. So I want to see a 50% retracement. What do I want to see also? I want to see price support to the left. I want to see a bottoming tail. I want to see a changing of color bar. I want to see volume spiking. I want to see the market moving in my direction. I want to see multiple concepts converging. Nothing in trading is great by itself on an island. We always want to see multiple concepts to help us out. Now, this next chart is just to show you guys different pivots. Is this a great tradable chart? Not really, right? This is not some special, amazing chart, but it's to show you level depths of retracements and what happens. So notice, here's a stock right here, okay, where it looked higher, okay? It looked like it broke out and put in a new high, okay? So put in a new high, and then you get a little bit of a red bar, and then bam, wide range red bar comes in, another red bar, but look at the volume and look at the bottoming tail. So the bottoming tail suggests higher prices. That's fine. That's normal. That's what bottoming tails suggest. But because of the fact that this is a wide range red bar and it broke two prior pivots, pivot here, what are we going to do? We're going to lower our expectation for the bounce. This broke two prior pivots on a wide range bar. Sellers are clearly in control, but a bottoming tail came in. So we expect a bounce, but the question is, what type of bounce do we expect? Answer, shallow bounce. Notice it's a 50% retracement and then it fails again. Okay, so it fails again, puts in a lower low, and again, the expectation is for a shallow bounce. I would expect a bounce to the $45 area and then a failure, but in this case, it didn't. Why is this important? It's important because stocks don't always do what we want them to do, right? So we have to always constantly reevaluate what we're seeing, and in doing so, reevaluate our expectation. So now, because this stock put in a higher high, albeit not by very much, I'm now expecting this retracement to have a higher low because it put in a higher high. So higher high, now higher low. So notice what's happening. The trend is beginning to change. Here we had lower high, lower low, another lower low, and then magically, for what reason, I don't know, but we put in a higher high. And because of the higher high, we have a higher low now. That's good. And over here, it chops around and then eventually puts in another higher high. So the point here is not that this chart is a great chart to trade. It's not. It's not a great chart. It's not even really a chart that I would trade or is buyable. But it's understanding the concept. Okay, it's understanding the concept. So price pivots and retracement levels are right in front of you guys. They're on every single chart that you see. Why is that important? It's important because it negates the need for indicators. As always, I'm not hating on indicators. If you want to have a moving average on your chart, fine. If you want to have a trend line, fine. If you want to have a Fibonacci, fine. What I don't like, or I do have a problem with, is when you have 5 indicators, 3, 4, 5, 1 indicator, maybe 2 on the high side. Because price and pivots always tell us what's happening. Take off the indicator. I can still tell you where the pivot is. Okay, so 100% retracements that happen after an M top or a W bottom have a much higher chance of continuing in the direction of the retracement. This is important. We're going to talk about it on the next slide. 100% retracements that happen after an M top are more likely to continue in the direction of the retracement. 100% retracements that happen after a V top or a V bottom have a higher likelihood of reversing, especially if there's a change of color bar or a bottoming tail. Note, they're both 100% retracements. But what's happening is one is an M top and one is a V top. Okay? That retest and failure, I've done a lecture on this also, that retest and failure is a very powerful concept. Go review it. Okay? So 100% retracements are less likely to set new highs or lows on the initial move. What this means is if you have 100% retracement on a V top or V bottom, you might put in a new high, but it's not likely going to come from the first bounce or the initial move. Therefore, if we choose to take these setups, we have to lower our expectation. Guys, do you realize how powerful and profitable of a trader you could be when your expectation is in alignment with reality? The problem comes is when your expectation doesn't match up with what the chart is actually showing you. When you have an expectation that is not in line with the chart, that's what I call hopium. Okay? Don't hope something's going to happen when the chart isn't suggesting it should happen. Look at the chart objectively. Ask yourself, what is the chart telling me? Those candlesticks, that's language. It's talking to you in candlestick form. Okay? Listen to it. It's extremely important because when you listen to the chart, you can reevaluate and adjust expectation. And trust me when I tell you, when your expectation is in alignment with the chart, you'll rarely lose. It's when it's not that you'll lose. Okay? So every retracement creates void, but the question becomes, is that void it creates, is it tradable? Okay, is it tradable? So let's take a look. So here is an M top, okay? This stock gapped up, moved higher, okay? And then it pulls back from 42.60 down to 42.20. And then what happens? It retests. It goes back to 42.60, peekaboos over the high, and pulls back. But here's the problem. It didn't just pull back to support here. It broke support, okay? It broke support. And now, once you break this support area, there's room to drop to the low of the day, which is at $42. Once you break below 42, now we have an unfilled gap. And if you have an unfilled gap, it's likely going to be filled. Why? Because it was an M top. Remember on the last slide I said if it comes from an M top and there's 100% retracement, there's a higher likelihood the stock will continue in that direction. That's exactly what happened. And you'll note the failed reversal attempt. The stock was right near support area, right between here and here, both areas of support. It tried to bounce. It put in a green bar bottoming tail. It even triggered. And then it failed. Now, is this something that I would be super aggressive and short? Probably not. But where could this be helpful? It could be helpful if you're long in this stock, right? Let's say you bought this stock, you're in a swing trade, or you bought this stock and it's moving up, it pivots, it's moving up, and all of a sudden you see an equal high and a pullback to 42.20. For me, I'm going to put my stop at 42.20. And if it breaks that area, I'm going to get out. If you're not putting your stop at 42.20, you want to give it, quote, a little more room, then you have to put your stop at $42. And if it breaks 42, the move is over. Stop drinking the Kool-Aid. Stop with the hopium BS. It's over. 42, once it's broken, it's done. The stock's going for a ride, and it's not the kind of ride you want to be on if you're long in the stock. Read the chart objectively. The chart is speaking to you. It's talking to you, telling me, get out, get out, get out. I'm going lower. Now, could you short it here at 40? You could, but it's an aggressive short. Right? Put your stop up here at 42.40. But I'm talking more about people that might be in it long because it gaps up, goes higher, pulls back, and pivots again. Get out of 42.20. If you want to give it a little more room, 42. Don't stay in for this move. It's going lower. Unequivocally, it's going lower. Okay? Let's talk about it again. This is a slide you guys saw a long time ago. Maybe a year ago I put this up. Okay? Same idea. Listen to the chart. It's talking to you. Don't ignore it, okay? It's not your spouse. You can't ignore it. It's going to cost you money. Well, that could too, I guess, right? So anyway, you're moving higher, chopping around 33.50, 34. The stock absolutely on the left here looks higher. It does. It looks higher. And then for whatever reason, it breaks support. We don't have to have a reason every time. Sometimes stocks are irrational, right? Okay, so anyway, the stock moves lower. It goes from support at 33 all the way down to 29 bucks. Okay, the moving average is showing the smooth trend lower. The stock bounces. It pulls back, puts in a bit of a higher low, but more significantly a double bottom bottoming tail. It bounces, puts in a relatively equal high. And here's the kicker. Here is the rub. So after we put in relatively equal lows, you could even suggest it's a higher low because it is by a little bit. Then we put in an equal top. Right here is the line in the sand. See this 30-50 area? Lower high, lower high, lower high, bottoming tail, bottoming tail, bottoming. There are 3 bottoming tails right here, okay? Guys, if this stock fails at 31.50, it's going lower, okay? Why? Because you just put in a slightly higher high. You just put in a higher low. Higher low suggests buyers are stepping up sooner. And because buyers are stepping up sooner, the expectation is to go higher and break this to the left. But if it doesn't, and in this case it doesn't, get out of Dodge. You don't want to be in this thing. Long story short, it doesn't put in a new high. It retests. This is a 100% retracement, right? Right here from 31.50, that's the pivot high area, down to 29 is a 100% retracement. We know we always have to question the strength of a 100% retracement. If it was stronger, it wouldn't have retraced 100%. It would have retraced 50%. So does that mean it's over for this stock? That's it. It's done. It's just going to go under 20. No, not at all. It's the exact opposite. We're using prior or past price action to predict future price movement. So take a look. Bottoming tail pivot, bounce. Bottoming tail pivot, bounce. Well, what happens when you enter an area? Remember, multiple concepts converging. We're entering double bottom support. Prior areas, plural, areas where the stock bounced, but we're entering that area 1, 2, 3, 4, 5, 6 red bars down. Guys, remember the lecture? Notice you can put all this stuff together. Notice the lecture we did a couple months back where we talked about bars being up 3 bars, think sell, 4 bars, really think sell, 5 or 6 bars, really think sell. Same thing on the downside, down 3 red bars, down 4 red bars, down. Well, we're down 6 red bars into a double bottom support area. And we have a wide range ending bar. Why is this an ending bar? That's another lecture we did because it's happening after 4 previous bars. It's not the first bar. It's not an igniting move. It's happening after 4 red bars. So it has to be an ending bar for a couple reasons. One, it's wide range. It's the 5th bar of the move. And it's happening right at support. And it's happening on volume. My goodness, how many check boxes can we go? Pilots and checklist. So this stock should be looking to potentially bounce in this area. Then what do we get? A green bar with a bottoming tail. Wow. Relatively smooth pullback. So technically we have room back to 31.50, right? We do. We have $2 worth of room here. But because it's 100% retracement, the expectation, the immediate expectation is not 100% retracement back up, is it? Go back to the slide we looked at a little while ago right here, okay? And when we have 100% retracement, the target is a 50% bounce. When we have a 100% retracement, the target is a 50% bounce, okay? So now that we know that, we can go back to the slide and go, okay, I have multiple concepts converging here. I am down 6 bars. I'm into double bottom support where the stock previously bounced. I have a volume spike, a wide range ending bar, and I also have a green bar with a bottoming tail. I mean, that's 4 or 5 concepts. So it's buyable, but the expectation is a 50% retracement. And that also happens to be where the moving average is. So the expectation here is to get in at 29.50 with a stop at 29, 50-cent stop, and trade it to 30.50. Now, does this mean you have to sell all of your shares at 30.50? No, but I would definitely take at least half off, at least. And then maybe it will get back to 31.50. Remember I said 100% retracements can put in new highs. They can, but you don't expect that new high on the initial move. That's the key. You don't expect the new high on the initial move. Okay? So, spent a long time on that slide, but it's very, very important to understand the concept behind it. Okay? All right. Man, we got a lot of slides to get there. We're going to have to hurry up. All right. So we have a stock. Let's look to the right. We have a stock gapping up, okay, over this pivot, over this topping tail. It breaks or is looking to break that red line. When it breaks that red line, we're interested, okay? But here's the thing, guys. This is where retracement levels matter. So let's go to the left. It's a 5-minute chart. Stock gaps up, okay, 66 bucks. It's above the area we need it to be above on the daily. It's above the topping tail on the daily. Good, awesome, wonderful. But there's no pattern here. I can't just buy a 2-minute high. The gap's not good enough to buy a 2-minute high. So it goes up, it pulls back. Now, a ton of you right now are going, sweet, I can't wait to trade this stock right here. Not so fast. Not so fast. Why? Well, if the pivot high is 68 and the pivot low here, at least the bottom is like 65, 75, what's a retracement to just above 66 bucks? About 80%. Now, I know some of you are going, but it's got a bottoming tail, but it's got, you know, a doji bar, but it's the moving average. I understand. So what you would want to do in this case, guys, hear me out. It's very important. You would want to take a partial lot on this initial 80% entry. Using the low, not the bottoming tail, using the low of the day, because it's an 80% retracement. Take a third of a lot, a half lot on the high side. And the expectation here is a shallow bounce, right? Shallow bounce is the expectation. We are actually looking for this stock to retest the prior low, right? To retest the prior low, okay? After the retest, then you can get full. But notice, even on the retest after you got full, it still had a little bit of an issue to the left. It still took 10 minutes to overcome the supply that was generated and created to the left, but it ultimately worked. So many of you right now are simply going, oh, I'm just going to go full. I'm going to buy that pullback. It's an 80% pullback. You have to at least somewhat question the strength of the stock on an 80% pullback. It shouldn't have pulled back that deep. So I'm not saying you can't take it. I'm simply saying take a smaller position, and then when it does the retest, add back. There will be an area to add somewhere almost always. There will be an area to add somewhere almost always. Okay? And that's what Anmol took. Right there on the retest. You can see the timestamp right around 10 o'clock. Okay, he called it at 9:57. It triggered right around 10:02. Boom. You guys made some money on it. Boom. Target hit. 5 minutes later. Okay, pretty good. All right. That's what a beautiful uptrend looks like. Right? So you have a stock moving up, higher pivot high, higher pivot low. Higher pivot high, higher pivot low. Higher pivot high, higher pivot low. So on the pullback, you want the stock to pull back 50%. Typically, the 50% should be the prior pivot high in an uptrend. Typically, the moving average should be sitting here. Bottoming tail should be sitting here. Changing of the color bar should be sitting here. Volume spike should be sitting here. What is all that? Multiple concepts converging in an area. If it retraces 100%, you have to question the strength and the trend of the stock. We've been down this road. So even if a stock is super strong, but it pulls back 100% to a prior pivot low, not a prior pivot high. Remember, the floor becomes the ceiling. Okay, the ceiling becomes the floor. Well, if it retraced 100%, I want to know why buyers don't want this thing. I want to know why people aren't stepping up sooner. The only logical explanation is it's not as strong as I thought it was. Be objective. Change your expectation. Okay? This is what a really good uptrend buy setup retracement looks like. This is really, really nice, guys. Okay, so you have a stock. Okay, on the left, wide range green bar, moves up, pulls back, moves up, consolidates, moves up, pulls back. But notice, the key thing to notice here is higher pivot high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. I mean, this thing is riding the moving average like a magnet, okay? It's beautiful. Notice this consolidation with the double top. That's a challenging area to overcome. But the beauty of it is once it's overcome, it becomes support. So when you're below the double top, it's the ceiling. And it's hard to break through the ceiling. But once you break through the ceiling now becomes the floor. So it should pull back to that area and buyers should step up. So from the top of the pivot at 37.80 to the bottom of the pivot at 37.10, we have roughly a 50% pullback. Moving average is there, green bar is there, beautiful. This is what multiple concepts converging in area look like. Price, volume, moving average, retracement levels. My goodness gracious, 6-to-1 move in a couple hours. Not bad, okay? This is what the retracement level looks like in transition form, right? We talked about the ceiling becomes the floor. This is transition form. So the stock was in an uptrend on the left. Then it goes into a downtrend in the middle here, okay? And then after that, okay, it bounces up with a wide range bar. But notice, this is important, guys. The wide range bar takes out the prior pivot. See the red line? It takes out the prior pivot. But notice where it pulls back to. This prior pivot high. The ceiling before becomes the floor. Beautiful buy setup, like stupid good buy setup. Bounces again, puts in a higher high. Notice the pullback is at the prior pivot high. The previous ceiling becomes the floor of support. Rip, they don't get prettier than this. This is the nicest weekly chart you'll ever see in your life. Okay? Rip. So you're getting in down here at 21 bucks, and by the time you actually get out of this thing, it's at $35, $37. My goodness. Pulls back here and pivots and goes higher. But notice, yes, it pulled back to some support. But notice that wide range bar. That's not something you generally want to see. Okay? Stock moves up, puts in a higher high, 100% retracement. Now this one defied the odds. 100% retracements don't normally rip off the bottom like this. Guys, they don't always do exactly what we want them to do. But that's okay. That's why we have stop losses when we're wrong. We're using odds, and the odds aren't perfect, but they do give us an edge. Okay? All right. Here's another example. This one is a little bit more challenging, right? So it's a buyable buy setup, but not necessarily easy. Why? So here we have a stock move up, chop around, breaks out, pulls back, and rips. Right? Two wide range green bars here. Pulls back. Lower high, in an uptrend. Technically, that's a buy setup. Per the rules that we teach, that's a buy setup. But if you take a look at the pivot high at 45, the pivot low at 35, it's at 41. It's actually more like a 40% retracement. The concern here, though, is look how far it is from the moving average. Yes, in this case, if you look at the retracement level, it's 40%. That's within the wheelhouse. 40, 50, 60%, right? We still want multiple concepts converging. So in this case, you would look at an entry right around 42 with a stop at maybe 40.50. So it's a $1.50 stop. You got 2-to-1 to the high, but there's not much there. So for me, this is a tougher buy setup. And the reason I'm bringing this and showing you this chart is because even though it meets the definition, it's still something that's not super easy to take. It's far away from the moving average. The retracement level's slightly shallow, but it does give a bottoming tail. It does give a doji bar. For me, I probably wouldn't take this, but yet it's a buyable buy setup. I would, if I did take it, probably lower my expectation a little bit on this because the retracement level and how far it is from the moving average. Okay? Same deal here. Here's another example of a stock in transition from a stage 4 downtrend, double bottom retest and failure, moves back up, puts a higher pivot high, and in this case doesn't really pull back much, it consolidates. After the consolidation, it breaks out, pulls back to support at like $5, and then rips. These are the best buy setups you can get. But note where it's pulling back, right to support. So that retracement level is a little bit deeper than you want, a little bit. But this higher pivot high, the moving average right below it, wow, right? Wow. Same thing on the short side, guys. Same thing on the short side. Once you break below this area, you drop, you bounce. Notice where you're bouncing. It's about a 40% retracement. If you take the high of the pivot at 39.60, the low at 39.10, it's happening at 39.35-ish, 30, something like that. It's a little bit shallow on the retracement on the right side. Drops, bounces, where's it? Prior pivot low. Drops, bounces, now we have more of a problem. We have a problem because the retracement now is pushing 60+%, and it's not happening right at minor price resistance. So the level and depth of penetration is higher than I would expect. And what happened? It didn't set a new low. It put in an equal low. Why? Because the level and depth of penetration was exceeded or more than we would expect, which means buyers are stronger than we initially thought. Right here, lower low, lower low, lower low, equal low. You should have seen this coming. I'll repeat it. You should have seen this coming because of the level and depth of retracement. Okay? All right. I think, guys, with that, I think we'll wrap it up. One quick comment. Here's a 3-bar play, guys, right? Wide bar, or 4-bar play, technically. Wide bar, narrow bar, super narrow bar, rip. So this is buyable, right, at 71.10. Absolutely buyable at 71.10. Bounces back up, pulls back, but note where it pulled back. The high of the pivot is here, the low of the pivot is here. So the retracement level is a little bit shallow, 40%, but this is price support, right? The high of that area, and then it rips, okay? Then it rips. One more slide here I want to show you guys. It's an important one. I showed it to you a couple months ago, but it's important, all right? This one's important, guys, because this is a stock that gapped up and moved higher, all right? There are a ton of people, admit it, okay? Raise your hand, just admit it, that when this stock pulls back right here with a bottoming tail, you are jonesing to buy this thing. Even though the stock gapped up, put in 2 wide range bars, green bars, and then it pulls it back and does 130, 140, 150% retracement. Why would you be interested in buying a stock that showed that level of weakness? I mean, guys, there's only 1 or 2 ways to look at this. 1, the buyers left the building. And 2, the buyers left the building. Okay, the stock ripped up. So why didn't it hold that level up top? Well, clearly, people were profit taking. Obviously, that's the only way you can look at it. The only reason the stock pulled back is there's more sellers than buyers, profit taking. But if it was still really, really strong, it would have pivoted right around here where my cursor is and bounced. If it was even a little bit strong, it would have pivoted at the low of the day because this is where buyers initially stepped up, and it would have bounced right there. But it didn't. It kept on going lower, okay? And it left a massive bottoming tail. What is the expectation? A shallow bounce. Guys, I get this question more than any question. Maybe not more, I'm exaggerating, but I get this question a lot. Somebody asks me about a stock on the short side or the long side, and they go, well, geez, Jared, what do you think about this? I said, likely it's going to bounce a few bars and then fail. And then it happens, and they go, Jared, you're Nostradamus. I'm not. It's what's supposed to happen. If you retrace 100, 120, 150%, you should not be expecting a massive bounce. That would be unreasonable. Read the chart. It's speaking to you. This chart is telling you a lot of people took their money and ran. A few people thought there's some value down here and I'm going to get back in, but the majority of people took the money and left the building, and they're not coming back. So the bounce, okay, there's always a few people out there. Where did it go? Shallow retracement, failure. Shallow retreat, failure. Rides the trend line down. And this is a gap up. Okay, that is on a gap up. So I'll end with this. Last slide of the day. Wide range, 2 wide range igniting bars. A third bar, stock is tired. Runs from 42.80 to 43.60. It's tired, guys. How much more can you expect? So the retracement level from the pivot high at 43.60 to right around 42.70, okay, give or take, it's about $1. It's sitting right there at like 43.10. That's about a 50% retracement. Lower high, lower high, lower high. 50% retracement, rising moving average, minor price support, bottoming tail doji bar. My goodness gracious, multiple concepts converging in one area, which makes it a better trade. Moves up, consolidates, rips, and then what do we get? A stock that's likely going to pull back, right? Because it's extended, it's climactic. But this is a buyable buy setup. You can add on the breakout, add on the 3-bar play, and then just get out of Dodge. Don't even wait for this pullback. Look, guys, 1, 2, 3, 4 bars up. Remember, 3 bars up, think sell. 4 bars up, really think sell. 5 bars up, get the heck out of town. Well, this is 4 bars up, wide range bars, huge volume spike. Just walk away. Okay, just walk away. So I hope that you guys enjoyed today's lecture on retracement levels, because they are very, 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 very important. Extremely super duper important, because they tell us where a stock is likely going to bounce. And being the level, 25%, 50%, 100%, it changes your expectation for the trade. And expectations are one of the biggest things you need to understand in trading. Guys, I don't have a problem if somebody's trading a stock that's $50 up. 5 days up. If they say, Darren, I'm looking to get 10 cents from it, I'm like, all right, that's fine. But if somebody says I'm looking to get $2 from it, that's a problem. Expectation is everything. All right. So I hope you guys enjoyed that lecture. We'll get back at it again next week.